Every financial textbook will tell you the same thing. When a country becomes rich, sophisticated, and deeply integrated into global markets, it eventually lets its currency float. It trusts the market. It loosens the leash. It grows up. Hong Kong did the opposite. One of the most advanced financial centers on earth still bolts its currency to someone else's. The Hong Kong dollar sits inside a narrow cage between sevens, 75 and 7. 85 to the US dollar, a band that has held for decades through crises, protests, booms, and busts. The United States prints the money, the Federal Reserve sets the interest rate, and a Chinese city under Beijing's sovereignty quietly shadows decisions made in Washington, D.C. every time the Fed moves. A shift in a committee room thousands of miles away ripples instantly through banks, mortgages, and asset prices in a city on the edge of the South China Sea. It's a paradox. Why would a place that calls itself Asia S-World City choose to live inside a monetary straitjacket? Why is Hong Kong the city that wouldn't float? Collapse doesn't always look like buildings falling or banks bursting into flames. Sometimes collapse is just a number sliding on a screen, a quiet panic behind polite faces. In the early 1980s, Hong Kong's money was doing exactly that. Back then, under British rule, the Hong Kong dollar was supposed to be a respectable, stable colonial currency. It had a flag, a government, and international banks lining its harbor. But the one thing it didn't have was certainty. London and Beijing were negotiating Hong Kong's future. Would it stay British? Would it be handed back to China? What would happen to property, contracts, and savings in a city built on trade and trust? Investors looked at that uncertainty and did something very simple. They left. They sold Hong Kong dollars, bought foreign currencies, and moved their wealth to places that looked safer on the horizon. In 1983, that slow-motion exit turned into a panic. The Hong Kong dollar went into free fall. On what's now remembered as Black Saturday, it plunged to around 6 per US dollar. Shops started pricing goods in foreign currencies. Residents rushed to convert their savings. Whispers spread that banks might fail, that the city's entire future was in doubt. This wasn't just a currency problem. It felt like an identity crisis. If the money could collapse overnight, what else could vanish? When trust evaporates, money evaporates with it. And when money evaporates, power does too. The government could see the spiral forming. No speech, no press conference, no patriotic slogan was going to convince people that a falling currency was stable. Words weren't enough. So Hong Kong did something radical. Instead of promising stability, it hardwired stability into the system. On 17th of October 1983, the government introduced a currency board. From that moment, the Hong Kong dollar would be linked to the US dollar at a fixed rate of 7, 80 to 1. If you brought US dollars to the authorities, they would give you Hong Kong dollars at that rate. If you brought Hong Kong dollars back, they would redeem them at the same rate. No negotiation, no suspense, just a mechanical rule. That single rule has defined Hong Kong's financial life ever since. On the surface, the system looks simple, almost boring. Imagine a rigid metal bar connecting two currencies. At one end is the US dollar, backed by the world's biggest economy in the Federal Reserve. At the other end is the Hong Kong dollar, a local currency whose value is locked to the bar. If the US dollar moves, the bar moves. The Hong Kong dollar moves with it, whether it wants to or not. Inside that mechanism is the heart of the system, a currency board. It rests on one promise. Every Hong Kong dollar in the monetary base is backed by US dollar assets held in a special pool called the Exchange Fund. In practice, that means the Hong Kong Monetary Authority, the city's de facto central bank, doesn't need to get to print money out of thin air the way most central banks can. If it wants to issue more Hong Kong dollars into the system, it must receive US dollars in return. The monetary base expands when foreign currency flows in and shrinks when foreign currency flows out. Money creation isn't a political decision, it's a mechanical response. New banknotes don't just appear because an election is coming or because someone in power thinks a little inflation might make the debt feel smaller. In Hong Kong, 3 commercial banks, HSBC, Standard Chartered, and Bank of China, Hong Kong, are allowed to issue notes. But they can only do it if they hand over the equivalent amount of US dollars to the monetary authority and receive certificates in return. Those certificates are the keys that unlock the right to print Hong Kong dollar notes. No dollars, no keys, no notes. The peg today isn't a single razor-thin line. It's a narrow band between 7.75 and 7.85. When the Hong Kong dollar drifts too close to the weak side, towards 7.85, the monetary authority steps in. It buys its own currency and sells US dollars, making Hong Kong dollars scarcer and more valuable. When the rate moves toward the strong side, near 7.75, it does the opposite, selling Hong Kong dollars and buying US dollars, releasing more local currency into the system. It's a constant, quiet tug of war, invisible to most people, but relentless. Behind this little dance sits a gigantic war chest. Hong Kong holds foreign reserves worth hundreds of billions of US dollars, far more than its monetary base. That isn't a safety net, it's a fortress wall. The message to markets is straightforward. There is more than enough ammunition to defend this line, but a fortress always comes with a cost. Because the currency is locked to the US dollar, Hong Kong's interest rates are effectively chained to the Federal Reserve. When the Fed hikes, Hong Kong hikes. When the Fed cuts, Hong Kong cuts. Local conditions matter, but they don't decide. It's like doing monetary policy by remote control. Washington turns the wheel, Hong Kong feels the bend. That arrangement can look calm in good times, like a sturdy bridge on a sunny day. It looks very different when the storm comes. In 1997, the Asian financial crisis tore through the region. Thailand abandoned its own dollar peg and let the baht collapse. Currencies in Indonesia, South Korea, and elsewhere tumbled. Foreign debt became unbearable. International rescue packages arrived with brutal conditions. The pattern looked familiar. Soft pegs snapped first, and once they broke, pain spread everywhere. To many speculators, Hong Kong looked like the next domino. The trade was simple. Borrow Hong Kong dollars, sell them, buy another currency, short Hong Kong stocks, and wait. If the government let the peg go, the currency would fall, stocks would crash, and those bets would pay off spectacularly. The monetary authority did something few expected. It didn't just defend the peg politely, it weaponized it. To keep the currency inside its band, it allowed overnight interest rates to spike to astonishing levels. Borrowing money to attack the Hong Kong dollar suddenly became extremely expensive. Shorting the currency meant swallowing interest costs that could wipe out profits overnight. At the same time, authorities took an even more controversial step. They marched straight into the stock market and started buying shares in massive quantities, squeezing speculators who were betting against both the currency and the Hang Seng Index. The government became one of the largest players in its own equity market, not because it wanted to own those companies forever, but because it wanted to send a message. The message was clear. If you bet against the peg, you are betting against a government willing to sacrifice short-term market purity to protect long-term monetary credibility. The authorities were willing to see asset prices swing, interest rates spike, and critics complain rather than allow that narrow exchange rate band to give way. For ordinary people and businesses, that defense came with a price. Interest rates soared, property values dropped, borrowers struggled. But while the region around it was engulfed in devaluations and IMF programs, Hong Kong's link to the US dollar held. Where other currencies finally floated and sank, Hong Kong's refused to move. After 1997, the peg didn't fade away as a temporary emergency measure. It became even more formalized. Authorities refined the linked exchange rate system, writing down explicit promises about the rates at which they would buy or sell Hong Kong dollars. Markets were given a clear rulebook. The system wasn't just a political slogan. It was a set of contracts that traders, banks, and investors could test day after day. Then came a different kind of storm, the global financial crisis of 2008 and the era of near-zero interest rates and quantitative easing. The Federal Reserve slashed rates to the floor and flooded the world with liquidity. Those dollars had to go somewhere. A pegged currency, open capital account, low interest rates, and a city acting as the gateway to a rising China looked irresistible. Money poured into Hong Kong, driving up stock prices, and even more, property prices. Once again, Hong Kong imported another country's monetary policy, whether it liked it or not. Ultra-cheap money fed a housing boom. The monetary authority tried to lean against it using its own tools. It issued more exchange fund securities to soak up excess liquidity. It tightened mortgage rules, raised down payment requirements, and used regulations to cool speculation. But it did all this without touching the core rule. The peg stayed. The pattern was clear. When the United States crashed and eased, Hong Kong eased. When the United States recovered and tightened, Hong Kong tightened. Sometimes this alignment suited local conditions, sometimes it didn't. But the choice wasn't really on the table. The currency board had made that decision decades earlier. Meanwhile, the world around Hong Kong was changing in ways that had nothing to do with interest rates. In 1997, the city returned to Chinese sovereignty under the one country, two systems framework. Over the decades that followed, Hong Kong shifted from a manufacturing and shipping hub into a high-end service and financial center deeply intertwined with mainland China's economy. It became the offshore home of the Chinese currency, a testing ground for a financial opening. The city launched offshore yuan trading. It hosted dim sum bonds denominated in China's currency. It built Stock Connect and Bond Connect schemes that allowed mainland investors to reach global markets through Hong Kong and foreign investors to tap Chinese markets through a familiar legal and financial environment. It became a bridge, not just between currencies, but between two very different financial systems. At the same time, politics grew more tense. Large-scale protests, from the umbrella movement to the demonstrations in 2019, drew international attention. The introduction of a national security law reshaped the city's political landscape and its relationship with the West. Commentators speculated that capital would flee, that confidence would crack, that the peg was finally living on borrowed time. Yet through all of this, the exchange rate barely flinched. The band held. The Monetary Authority repeated the same line. The linked exchange rate system is the cornerstone of Hong Kong's financial stability. The reserves remained enormous. Interventions came and went. Money flowed in and out, but the currency stayed in its cage. In more recent years, pressures shifted again. For much of the 2010s and early 2020s, one of the favorite trades in global finance was borrowing cheaply in Hong Kong dollars, converting into US dollars, and buying higher-yielding US assets. As long as the peg held, the exchange rate risk looked small, yet the interest rate difference could be harvested as profit. It was, in essence, a bet that the cage would not break, but carry trades are loyal only in sunshine. When the US dollar strengthens and US interest rates rise, the Hong Kong dollar tends to drift toward the weak side of its band, pressing against 7.85. Each time that happens, the Monetary Authority steps in, selling US dollars and buying Hong Kong dollars, draining cash from local banks. Liquidity tightens. Short-term interest rates can spike. Headlines declare that Hong Kong is defending the peg once again. The system is doing exactly what it was built to do, but everyone can feel the strain. So why keep it? Why has Hong Kong chosen to remain the city that wouldn't float, long after many economies of similar size and sophistication have allowed their currencies to move more freely? The first answer is credibility. The peg is more than a number. It is a promise to markets that whatever happens in politics, the money will behave predictably. No surprise devaluations, no hidden capital controls, no midnight announcements that erase decades of savings. In a world where trust can vanish in a tweet, that kind of predictable anchor is rare and valuable. The second answer is identity. Hong Kong built its role on being a bridge between East and West, between a rising China and the existing dollar-based financial system. Pegging to the US dollar tells the world that it plays by rules global investors understand. Being part of China tells Beijing that it remains a key strategic gateway. The peg is the metal bar holding those two identities together. Remove it too quickly, and the bridge starts to sway. The third answer is power, though it might not look like power at first glance. A floating Hong Kong dollar would give the city more flexibility on paper. Local policymakers could cut interest rates independently, or let the currency weaken to support exports during recessions, or use devaluation as a hidden tax. But with that flexibility comes temptation. The temptation to quietly shift pain from the government to savers through inflation. The currency board removes that temptation. If the peg is to be believed, the city cannot print its way out of trouble. It has to accept real adjustment, higher interest rates when external conditions demand it, lower asset prices when money flows out, slower growth when the global tide recedes. That discipline is painful. It is also precisely why some people trust the system. Of course, no peg is immortal. History is full of fixed exchange rates that held until they didn't. The gold standard dollar pegs in Latin America, Europe's pre-euro exchange rate systems, the Thai baht before 1997. All of them looked solid, reasonable, even inevitable, right up to the point where defending the line became more expensive than abandoning it. At that moment, mathematics and politics collided. Politics blinked. Hong Kong's situation is more complicated. On one side sits a classic economic dilemma, often called the impossible trilemma. You can choose two of the following: a fixed exchange rate, free movement of capital, and an independent monetary policy. Hong Kong has chosen the first two. It has sacrificed the third. On the other side sits geopolitics. Beijing is slowly pushing the Chinese currency to play a larger global role, using Hong Kong as one of its main channels. The United States remains the anchor of the dollar system that Hong Kong is wired into. The city is a hinge between two monetary worlds that are competing more openly year by year. A future where Hong Kong's currency system never changes is hard to imagine. Demographics shift, politics evolve, regional and global powers rise and fall. Yet a future where it changes suddenly is also hard to see, because for now the numbers still point in one direction. Huge reserves, a clear rulebook, a long track record of defending the band even when it hurts, and a political decision that has survived more than one kind of crisis. Betting against that is not just betting against a currency. It is betting against the willingness of a government to endure economic pain, market criticism, and international speculation, rather than admit that its core promise has failed. Hong Kong's story is unsettling because it forces a simple realization. Money isn't just paper, metal, or digits on a banking app. Money is a list of promises that someone, somewhere, has to be willing to keep when it becomes inconvenient. A fixed exchange rate is not stability handed down from the sky. It is a choice that must be defended over and over again. When you see a peg, you're seeing that choice in action. A choice to trade flexibility for predictability. A choice to import another country's interest rates. A choice to stand on a tightrope between two systems and keep walking, no matter how strong the wind becomes. Hong Kong chose to be the city that wouldn't float. The question isn't whether that decision will last forever. History suggests that no financial arrangement does. The real question is how long a city can balance between empires, chained to one currency while serving as the doorway for another, before the tension between politics and mathematics finally demands a different answer. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.